Hello, Steve Lentz here with Discover Options, and welcome to this market report. This will be for Friday, August 19th, getting ready for the open on the 22nd. Presented material is for educational purposes only and should not be construed as personalized financial advice. We would love for you to subscribe to this. Just click on the button below and we'll make sure you can get alerts then by the YouTube system. Also, if you want a free ebook, you can certainly click on the link above right, I believe, and you'll be able to acquire this free ebook by myself and Jim Graham called Simple Steps to Options Trading Success. Now we're going to give you two different market reports here today. First will be the Condor and Butterfly timing report, and this is for advanced options traders that like to trade within tight ranges. You're predicting that the market will not be as volatile as what the option prices are implying. The other report we'll give you is the likelihood report using statistical and implied volatility. And this is going to basically answer the question, given to the current market condition, is the market likely to go up, down, or wobble around a little bit? And so what we do is we go back in time and look at similar periods where we had the same kind of condition we have as of Friday, and we just evaluate that and answer that question. But I want to go over the why of the Butterfly and Condor report first. We'll give you the methodology, and then we'll give you the current condition and the edge level for those of you that trade Butters and Condors and similar range trading type advanced option strategies. Why would you want to look at this report? Well, here was a time when you may have thought about doing Butters and Condors where the market was channeling in a tight range, and in this case our report would have flashed a negative edge, giving you a warning, meaning that there was a higher than usual likelihood that the market would be more volatile than what was implied by the option prices. That's a tough environment to trade Butters and Condors in. Butters and Condors are meant for markets that don't move around as much as what the options are implying. And so our report and the methodology we used was flashing a negative edge at that point. And indeed, the market did go down and it was very difficult to trade in that environment. So that's kind of just a setup for what we do here. Here's the current market condition. As of Friday's close, the price action, trend, and overbought oversold levels, those are the three areas we look at. Occasionally we'll look at average true range to see if there's an unusual condition, but what we do is we customize these parameters to define the current condition. So price action wise, Thursday was an upswing day with a higher high and higher low. Friday was a downswing day with a lower high and a lower low. All this occurred while the trend was up. The close was above the 50-day simple moving average. And in terms of the stochastics, the 15-3 stochastics, we were between 65 and 95, and the stochastic is above its 3-period simple moving average. So this all makes for a very unique market condition. It's occurred about 80 times going back to January of 2000. January of 2000. All right, so we're going to answer the question though, given this market condition, is this a good one for selling option premium through range trading strategies, Butters and Condors, for example? All right, now to answer that, here's our methodology. We're going to first observe how much the market actually moves from any given close. We'll call that actual volatility. We'll then observe how much the market move, what market move is being predicted by the option prices. That's implied volatility. We're then going to compare the two and then label each bar going back to Jan of 2000. We're going to label it favorable or unfavorable for selling premium through range trading. Here's how it works. Let's just go, drill down a little bit and get in the weeds on this. All right, you can take any close, and we're going to go forward 21 days, 21 bars, and observe how much the market moved. If it went up or down, we want to get the maximum move that it encountered. And here it went down about 50 points. Okay, that's the farthest it moved in the ensuing 21 days from 2076 to 2026. 50 points, means that it ended up moving 2.4%. And that's just what the indicator says down there that you can see. Now here's the question. At that same time, on that same close, April 28th or so, what market move was being implied by the option prices at the time? We know it moved 2.4%. In this case, the VIX was implying a 4.4% move. So in that case, that bar happened to turn out to be favorable for selling premium. The market didn't move near as much as what the option prices were implying. That was a favorable bar for selling premium. So what we do is we go back in time and we label each bar blue or red. Blue is for favorable, like what I just showed you. Red is for unfavorable. That is when the market ended up moving more than what the option prices were implying by the VIX. Okay, so favorable and unfavorable. And what we like to do is historically ask ourselves what percentage of all the bars are favorable. Then we get that baseline, the benchmark. Then we look at those bars that match our current market condition as of Friday. We know that there were about 80 of them. And we ask ourselves what percentage of those were historically favorable for premium selling. And if there's a big difference between the two, then we conclude that there could be an edge or possibly a negative edge. So here you can see, going back in time, roughly about 4,150 or so, a little more than that, over 4,100 bars, 64.6% of those ended up being favorable for selling premium. 35.4% ended up being unfavorable for selling premium. Now then, when we look at our current market condition, here the question is, what percentage of these 80 that match our current condition, what percentage of those, what happened here? Let me put that back, send it back. What percentage of those were favorable for selling premium? And in this case, 71.2% ended up being favorable. 71.2% ended up being favorable. Now, what does that mean? That means that we have an edge of about 6.6%. 6.6% ended up is the edge. 71.2 minus the 64.6 benchmark means that we have an edge of 6.6. That means there's a higher than usual likelihood that the market will be less volatile than what is implied by the option prices. So it's better than flipping a coin or just picking a day of the month. You know that if history plays out, there's a I would call this an average or small edge to selling premium at this time, based upon what the past has shown about this current market condition as of Friday, the 19th. All right, so that's it for the Condor Butterfly Timing Report. There is an edge right now. Let's take a look at the Market Likelihood Report. Before we do that, I want to make sure you understand at Discover Options, we offer wonderful one-on-one mentoring that'll take you from being a beginner or an intermediate all the way up to an advanced trader capable of even managing money if you have that kind of desire and discipline to pursue that. We offer several different tracks, I would say there's probably 28 different courses that we teach, each with a mentoring session attached to it. We bundle those in various packages for you to take a look at. Go to discoveroptions.com and you can look at these. And we have a group of wonderful, very experienced professional option traders ready to help you get to where you want to go in your options trading career. And it could be just putting an overlay on top of your long holdings, simple as that, or you could do the non-directional butterfly condor stuff and really shoot for some superior returns that way. Let's go to the Market Likelihood Report using statistical volatility. All right, so let's take our current condition. Here's the question. Since Jan of 2000, how often has this same condition occurred, and what direction did the market go? So we're going to identify this condition as I just did. We go back in time. I note that there's a roughly 81 different times it occurred in the past. All right, and we're going to see from the past where it went to. Now, to do this, we have to define the historical distribution of price and then compare the distribution that occurs after our market condition has occurred. And if there's a big difference, then there might be a trading edge there. See that? And the reason we do it this way is because if I'm only looking back at a bull market, and I know that historically from each close the market goes up a little bit, and then, well, from the current market condition it also goes up. Is there much of an edge? Probably not really. So I want to go back in time far enough that it encompasses both bullish and bearish markets. All right, and then we observe that historical distribution. So let's go, let's see how we do this. How do we determine historical distribution of price? We measure this by observing how often price touches one standard deviation bands, volatility bands, that are placed from each bar's closing price. I do this in 5, 10, and 15-day increments. Each band is measured one standard deviation from the close. I use 20-day historical vol log normally distributed. Here's just a little example real quick, just so we get this. We go from the close. We go up a standard deviation that's 10 days out, go down below, and so I have an upper band and a lower band. And here's the question. Did the market in the ensuing 10 days go up and hit the upper band, go down and hit the lower band, or did it wobble around the middle and not hit either of them? And in this particular case, the market definitely went up and hit that upper band right there. See that? Okay. And so that's what happened on that particular close. So in our database, we record that it hit the upper band. Now let's go to this close here. And we go to the upper band. We have the lower band, and we're going to ask ourselves, did the market in the ensuing 10 bars hit the upper band, the lower band, or wobble around and not hit either of them? And in this particular case, it indeed tried to go down and hit that lower band, but it failed to if you look real carefully. So in this case, it hit neither of them, and that's what goes in our database as we determine the historical distribution of price. All right, so what we do here is from every close, we record how often price struck the upper and lower 5, 10, and 15-day bands. We're just getting a distribution of price in a benchmark fashion, and here's what we have for the SPX. Going back to Jan of 2000, price from all the closes, 4,172 occurrences, price hit the upper band 29.4%, the upper 5-day band, the upper 10-day band 23%, the upper 15-day band 23%, the lower 5-day band about 30%, the lower 10-day band about 30%, and the lower 15-day band a little bit more. So that's the benchmark distribution, the historical distribution. Now, we are going to look at understanding the distribution after our specific condition. And not only are we going to look at the distribution as of the close on Friday, and for each of those 80 going back, but for each of those 80 going back, we're going to ask ourselves, of those 80, what was the distribution if price went above the high, in this case from Friday's high? Also, how was price distributed if price happened to go below the low of Friday? So let's take a look at that, shall we? Let's take a look. Here we go. As of the close on Friday, okay, look at this. Price for each of those 81 occurrences that match our current condition, price hit the upper band 23.5% of the time, which is less often than the historical distribution. It hit the upper 10-day band 17.3, which is far less than the 23, and then on the upper 15-day band, it struck that band 4.4% less often. On the lower bands, it hit the lower bands a little bit less often as well. So what we're seeing here is that as of the close, Price struck all 6 of the bands less often than the historical distribution. So this is a picture of a current market condition where it's more likely than not, it's more likely, historically more likely, that price will be less volatile than the historic benchmark distribution, where it's hitting all 6 of the bands less often. That's a picture of lower market volatility. All right, now, what if price ends up going above the high from Friday? So that occurred 45 times in the past. In 5 of the 6 bands, 5 of the 6 bands happen to be struck less often than the historical distribution if it goes above the high. Only in this one little case did it just slightly go up above the upper 10-day band. Okay, let's look at what happens if it goes below the low of Friday. That occurred 40 times. Looks like there were about 4 or 5 instances where it was an outside bar, went above the high and below the low. Again, in 5 of the 6 occurrences, in 5 of the 6 bands, the 5 of the 6 bands are getting struck less often than historically. So all in all, definitely a picture of lower market volatility. That's what's being predicted here. If you think that history has anything to predict of the future. Now, one thing I like to do is recast these bands. Instead of using a 20-day historical vol, we use a SKEW adjusted VIX level. Now, what do we mean by that? So we're going to take the VIX, which is a higher value typically than the 20-day statistical volatility. Because the VIX is higher, those bands then, the VIX bands, are going to be out wider, and they're going to get struck less often, as you can see. See that? They're getting struck roughly 14 to 21% or so, instead of 23 to 32%. So the bands are wider, they're getting struck less often, but here's the other catch. The upper bands are using a lower volatility than the lower bands. That's because in the SPX cash options, the out-of-the-money calls have a lower implied volatility than the out-of-the-money puts. We call that a vertical volatility skew. And the CBOE publishes a skew number that reflects the severity of that difference between the out-of-the-money calls and the out-of-the-money puts. All right, and because that's what the market is reflecting. Typically, the SPX goes down much more volatilely than it goes up, and that's reflected in the option prices, and that skew value reflects that. So I'm taking the VIX, carving it up into 2 different volatility numbers, an upside volatility and a downside volatility, and that's reflected in these bands you see here and how often they get struck. Even with that adjustment made, you can see that all 6 of the bands are getting struck less often when we do our little historical study. If price goes above the high, still 5 of the 6 bands are getting struck less often. And if price goes below the low of Friday, going back, you can see that all 6 are getting struck just a little bit less often, not very much. But that's kind of the picture we have here. And as you see down below, what I did is I'm giving you the upside volatility and the downside volatility. Now, let's go to a trading idea if you're at all bullish, okay, or you think the market's just going to chop around a little bit and not go anywhere. Let's take this downside volatility and let's go to option view and let's play around a little bit. 13.4% is the predicted downside volatility. Let's look at the strategy we look at most every week here is a hedged bull-put spread. Now with that data in option view, what you could do is click on a little button up here, the statistical volatility button, put in 13.4, and it now will define for you the 1 standard deviation level of all the strikes. And so if we were to go just outside of standard deviation here, we would be at the 2090 and do a credit spread. And to hedge that, we go to the at the money puts and buy a bear put spread. So just a 1-lot bear put spread, a 5-lot 20-point bull put spread. Has to have a net cash flow of positive, of course. All right, and when you analyze this thing, look at this. Not too bad. Boom. All right, and what you get then is just a great picture here where no matter how far the market goes up, you can make money, so you're not going to sweat the upside move like you do in some butters and condors. If the market goes down, you have this hedge kicking in and then lifting the T+ lines like that. You see that? So if the market goes down and gives you a headache, at least you're getting paid for it with this hedge. And at expiration, certainly you could make, look at this, 3 times what you would make if the market went up and you finished up at expiration. If the market hits that short strike of that bull put spread, looks like you're going to end up losing roughly 1 to 1. You're risking 1 unit to make 1 unit if it goes down in that 1 standard deviation level right there. You can make 18%. All in all, a pretty decent strategy. Something I think you should consider, at least as part of your repertoire. Here's the price chart with the profit region thrown in there in the green. So if price is in the green, it's going to end up making some money there. Not too bad. Folks, thanks for joining us for this edition of the Market Reports with Discover Options. I'm Steve Lentz. Thanks for joining us. We'll see you next week. Take care. Bye-bye.